Hi, everyone. I'm Rick Bensignor. Today is August 9th, a Tuesday, and welcome to this week's In the Know Trader Show. We've got a very interesting show today for you in our trader education portion. We're going to talk about that the reward that you potentially have on any given trade is in proper proportion to the risk that you're going to take on that trade. So we titled this as Make Sure Your Reward versus Risk Makes Sense. And then in our sector highlight, we're going to look at financials this week. So we'll take a look at the XLF ETF, we'll look at it versus the S&P, and then we'll go through the top 10 holdings by capitalization in the financial sector, starting with Berkshire Hathaway, the heaviest weighted name. To sign up to get my weekly ETF Tactical Trader reports, comes out Thursday nights. Please go to intheknowtrader.com. That report goes through the entire macro environment. We'll look at stocks, bonds, currencies, credit spreads, and some commodities. Then give you a specific new ETF trading idea each week, and also run you through every open position that we have until it's closed out. So we update how we get out of them, move stops, take partial profits, etc. That's the weekly Tactical Trader report. Comes out every Thursday. The other report that I make available for In the Know Trader clients is the monthly 7-Eleven report. That report is designed to beat the performance of the S&P 500. And I'll just bring you up to date. For this year, we're ahead by 2.6% as of July 31st. We've outperformed in 6 of 7 of the months this year. And even more importantly, over the 2 years since we started that publication on August 1st, 2020, we have outperformed the S&P by 716 basis points, 7.16%. That, as I've told you before, if you've listened to my shows, that would put us in the top decile of all active money managers whose goal it is to beat the S&P. So that comes out monthly. You'll get it on the last day of the month, going into the new month, so that you can make the proper allocations, as I've suggested in the new monthly report. So we just had one out last week on August 1st. This is for anyone, especially if you're an individual, has a fair amount of money in the passive stock indexes, and if you are a financial advisor who has a fair amount of money of your clients in SPDRs or similar, you should really take a look into this report, because we have done what very few people on Wall Street do over time, and that is outperform the market. We have the statistics on this besides just beating it. The Sharpe ratio is outstanding. The winners to losers is something like winning months to losing months is something in the neighborhoods of 75%. And again, you'd be up over 7% in 2 years versus the S&P. So I've also, and you're probably watching it now from this, I've started my own In the Know Trader YouTube channel. The way to get to that is to follow this link here. I note to you that this last digit here is a 0. It's not the letter O, it's a 0. So if you go to the channel, you can follow the channel, and therefore every time I put up a new video, you'll get an email notification saying that I've put up a new video. I'll still try to do these by and less on a weekly basis, but signing up and kind of following the channel will give you that notification when I put new videos up. And lastly, my Twitter handle, if you want to call it, is @InTheKnowTrader. I don't tweet often, but certainly you should follow me on Twitter too. All right. Before we start getting into today's information, what I do want to show you is the relative rotation graph of the 11 SPDR macro ETFs. This is, of course, the 11 separate sector SPDR ETFs that exist to follow utilities, technology, financials, consumer staples, consumer discretionary, etc. Each one of these 11 here are one of the sectors of the market. And this relative rotation graph, any sector that's in the upper right-hand corner is leading. It's both outperforming and continues to have positive momentum. If it's in the weakening phase, it's outperforming, but has lost positive momentum. If it's in lagging, it's underperforming and still has and is speeding up its lagging effort. And if it comes here in the upper left corner, it's improving. It's still underperforming, but it's starting to show improvement. So this tends to go in a clockwise fashion. But what's most important here, if you've never seen this before, is, and I've put an 8-week tail. So you can see over the last 8 weeks where each of these sectors have come from and where they currently are. So currently, there is nothing that is actually outperforming and has positive momentum. Bunch of these sectors that are in yellow were there within the last 8 weeks, but have lost upward momentum. And if you look at what they are, XLE, XLU, XLP, XLV, these were a lot of the defensive sectors have certainly lost steam, as the ones that were beaten down, like technology, like consumer discretionary, and certainly communication services, which is still struggling. Of course, XLC, the two biggest names in that are Google and Facebook, or Meta. So those continue to struggle, and that's why the sector basically as a whole is struggling. But we've definitely seen increased performance and momentum coming out of technology and consumer discretionary. And so these are the possible future leaders. And we've lost energy as, a main leader on the year. It's still right up at the top of the pack. But if you look over the last couple of months, it certainly has had trouble. And that's very much in line with the fact that crude oil has fallen from, the $120 level to now near $90. And so energy names have given back a lot of the outperformance they've had this year. So this is something that I look at with some regularity. It's not often I include it in the weekly show, but maybe I'll start doing it a little bit more just to give you a sense of how these are looking relative to each other as far as their performance. Okay, let's get to the crux of the educational portion for this week, which is make sure your reward versus risk makes sense. So let's think about this. If you're lining up a potential idea to trade, and let's say you've got a $20 stock and you see, let's say, $5 as a likely possibility that you're going to make on this trade, right? So $5 over 20 is 25% upside. If you don't see strong support until $15, well, then you're risking 5 to make 5. And it's not too often that you really want to take a trade that you have to risk as much as you're potentially going to make. Now, if you see enough upside momentum and let's say a technical breakout, it may be that you're willing to put on a 1-to-1 ratio, how much your reward is versus how much your risk is. But generally, you want to be more in the neighborhoods of 2-to-1 to 3-to-1 when you put these trades on. And if you're closer to 1-to-1, when you consider the slippage that's involved as you execute, at least nowadays, we don't have to bring commission into the equation, because in days gone by, that always took profits away because you had to pay money to both get into a stock and get out. Now, your commissions are free. To me, I suggest you find a really top-notch broker because one way or another, they're going to have to make money. And you really want to find a place that has top-notch execution. Now, Obviously, if you put a limit order in, you're going to get filled at your limit if it trades beneath you. But when you put stuff in at the market, often you take a look at how you're getting filled. Do you get filled at mid prices, or are you always paying the offer or selling the bid? You'll see on many stocks you can actually get filled at essentially in between prices, fractions of pennies. So just pay attention to that as you trade. But again, in the bigger picture here, we don't have to worry that much anymore about the cost of execution. So it really comes down to how good are you at picking your entry levels, your targets that you're willing to play for, as well as where you stop yourselves out. So to me, in general, if I think I can make $5 on a stock, I don't want to be risking much more than $2, maybe $1.50 to $2. I really don't want to be much beyond that. Although, if I'm risking 2.5 and I can make 5, that's still 2-to-1, and that's fine. Just be careful once you start getting closer to the 1-to-1 ratio. And that's something that you need to know about no matter what you're doing in the marketplace. You always want to pay attention to how much do I need to risk versus how much am I likely to make on the trade. And there are plenty of times in life I have passed up getting into a stock that I could have made money on, but because I had to risk as much as I saw the likely risk in getting into it, in other words, I couldn't find a strong enough support level, let's say nearby current price, that would really tell me if that level broke, I don't want to be long that name, such that I've passed up trades that would have made money, but the risk versus reward ratio was just out of whack. And I think over time, this is something you want to pay attention to and look at how you do this as an individual and whether or not you're successful along those lines. Because I often have, I do a fair amount of coaching for individuals through the In the Know Trader site. Anybody who is interested in hiring me for coaching, just go to In the Know Trader, click on the coaching tab, and sign up for coaching sessions. And we typically, we start with a 1-hour session, and you can get as many sessions as you want, but we don't do less than a 1-hour session, as that's the minimum amount of time I think I need to spend with you to just get some sense of what you're doing and to offer up some type of improvements to how you do things. But I get emails and people contact me, and especially people I'm coaching frequently, who say that, I'm constantly getting stopped out. Well, you probably have your stop too tight. So you've got to put your stops in a place that is within reason of what you're willing to lose on a trade, but also not be so tight that with just a little market noise in either direction, you kind of get stopped out before that move comes. So there's a lot to this when you measure risk versus reward. You can certainly make your risk very little, but if you're going to get stopped out 9 out of 10 trades, it's you've made your stops way too tight, and net you're losing money. The other way I want to look at this is, let's take a look at a chart here. Now, this is the S&P 500, and all I've done is put on a downtrend line from all-time highs and a Fibonacci retracement from the all-time high to this year's low. No other metrics, nothing else. And I say this, and the reason we're going to look at this is you can see that we've now, over the last few weeks, crossed above the 38% Fibonacci retracement level, the first of the three that most people generally look at, which is 38%, 50%, which is the red line, and then the higher blue line here is 62%. And in coming weeks or months, you're going to have one of the biggest decisions of your investment career to make. And that is, do you play this current up move that's lasted now, I don't know, about 7 weeks or so since we made the lows? Are you playing this as the bottom is in to this entire decline, and we're good to go going forward, and at some point the S&P is going to make new all-time highs, and the long-term bull market continues, or is this a rally in a bear market, and how high will it go? And what if it is, are you going to be willing to sell into this rally? So if you turn on the business channels or read the Wall Street Journal, you're going to have people on both sides of that argument. And ultimately, you're the only one who can make that decision. So if you're going to go under the assumption that the lows that were made early this year stay the lows, then at what point do you come and put more exposure into the market? And how do you manage the risk on that? Do you, let's say, even right now at current price, 41.15. If you buy now, where would the market have to trade to prove you wrong? And how much on the upside do you think you have? Do you think the market will get above the downtrend line from all-time highs? And if it does, not far away is that 62% retracement level at 43.67 in the S&P. And we know that these Fibonacci numbers often can be turning points. There's plenty of times they're not, but certainly technicians look at these as potential places a market could stop moving in the direction it's been moving in, and go back the other way. So I bring this up because as we've now kind of entered what I call the Fibo box, the Fibonacci box, which is between the 38 and the 62% retracement levels, if you don't think this is a bull market, then somewhere in this zone is probably where you want to reduce exposure. If you think we're going higher, then you're not looking to reduce exposure, and you're probably looking to buy pullbacks. But when you buy, is there any place that you're willing to risk that would force you out other than the market making new lows? If not, you're potentially risking several hundreds of points in order to potentially make a few hundred points, unless this blows to the upside. And again, nobody knows. And all the people who you see on TV or read or radio, wherever it is you're getting information from, cannot do anything except guess. They can collect their data, they do their research, but nobody knows what's going to happen next. And therefore, you still need to make the decision of which way you think the market's going to go in order to make a smart decision as far as, do you play this rally as a real rally, or is this rally a gift to sell into in order to reduce exposure? And the more we go up, the more the bulls are going to be bullish. And the problem for an individual investor also becomes, the higher we go, the risk reward changes upon first getting long. Let's say if a month from now we were 150 S&P points higher than we are now, then if you first got in at, let's say, we'll call it 42.50, just for argument's sake, now where do you decide that if the market goes down, you're wrong? Are you going to wait until we take out this year's lows? These are the type of things you have to ask yourself when you decide to buy or sell. Let's turn this around. Let's say you're going to use this rally to sell into. Wherever it is that you decide, or whatever zone and area in the market you decide to lighten your exposure because you're concerned that there's still big issues at hand and that stocks may not have bottom for this year or for the whole kind of bear market that started, you've got to also decide where you would re-enter. If you sell out at, again, I'll say 42.50. If you sell out at 42.50, plus or minus, who knows, 50 points. I'm just essentially saying there's no one price you're going to get out at, but let's say you use a range between 4,200 and 4,300 for an example. How much are you willing to see the market go above there before you say, maybe that was wrong to lighten up? This really does look like it's going higher. Versus how much downside do you think the market has before you take that same amount of money that you've sold out from the market to put it back in? So if you thought that we were going to retest the lows, then selling, somewhere in the low 4,000s, what do we say, 4,250 as just the example I used. If we get under and test under 3,700, well, then you've got 550 points that you're potentially going to wait to see this market decline, which on a percentage basis is significant. Obviously, it's more than 10% because from 4,250 in the S&P, 425 points would be 10%. So if we're talking over 500 points, it's more than 10%. Would you risk 10%? In other words, another 425 points, which puts us up to 4,850, which is essentially the all-time highs, before you'd say, I was probably wrong to have lightened up. I probably should get back in. I don't have the answer for you, but what I will tell you is you need to incorporate that concept into what you're going to do in your portfolio. Now, you could just do nothing and say, if you're 30 years old and listening to this, then if you probably don't need to do a heck of a lot, because as far as long-term investing, you're not going to really find a better place to put your money than in stocks. And that is historically proven over the history of equity market trading. You're not going to find a better investment. And don't send me an email about Bitcoin or something, because that's still not a viable investment as far as I'm concerned. It's pure speculation. You might make money, but you can't be sure over time you're going to make money with that. And plenty of people, it's already lost 2/3 of its value in the last year. You've got to decide this and think about how you're going to position your portfolio. So if you're young, this market sell-off just gave you an opportunity to get some stocks cheaper than they were. And especially if this is, let's say, retirement money, then you're talking 30 years or more before you're going to touch it. There's no better place to be than the stock market over 30 years time frame. But if you're 50, 55, 60, 65, 70 and listening to this, then you have to be a little more conscious about how much exposure do you want, when are you going to need that money, and you have to think about what happens if the major down move we saw is not done, and that everything that's been an issue so far this year, both politically, economically, still has major unresolved issues that still come back to haunt the market. So, for instance, let's say the Russia-Ukraine war gets far worse in lots of different ways that completely stagnate the European economy. Well, the U.S. is not going to be untouched. We may do better than Europe, but this is going to have global effects. What happens if the supply and demand picture for oil changes and oil goes back to the highs at 130 a barrel, if not all-time highs above 147? That's going to materially change the ability for the market to move higher. It'll be good for energy stocks, but virtually nothing else. What happens if China-U.S. relations get far worse because of, let's say, an issue over Taiwan or whatever it is? These biggest issues that have been were issues for the market, and of course a tightening Fed. I didn't say that, but we know, and they made it very clear last week, they are not done tightening. So you have everything that pushed the market higher for years, much of it has unwound. And is this, a bounce to sell into, or did we see the lows? And you've got to kind of determine as best you can. We clearly have some resistance right around where we are now. Like take a look at where, prior lows were, where we came back to in early spring, and then where we are now. We know there's resistance right about where we are. Doesn't mean we can't push through, but you've got to make decisions in your portfolio as far as how you're going to play this. And I urge you to incorporate the whole idea of, if you're going to sell out, but you're going to buy it back if the S&P falls 100 points, that be kind of, unless you're a pure trader, you wouldn't sell out of half your portfolio's exposure to equities to play for a 2%, 2.5% move in the S&P. If you thought the S&P was going to fall 10%, then yeah, you probably would. And same thing in the other direction. These are some of the things that a lot of people don't talk to you about, but they're actually some of the most important decisions you're going to make. And you need to put them in perspective of, if I make a big decision, how much am I going to risk if I'm wrong before I really need to reevaluate? And how much am I willing to think that I'm right and wait for the potential down the road to get back in at a better price than I had gotten out at? So that's today's trader education portion on making sure that your risk versus reward is very much in line and in an acceptable amount and something that makes sense. All right, let's take a look at, we said we're going to focus on the financial sector today. So let's start off with the XLF. And what we see in the XLF is the bottom that was made had virtually 1, 2, 3, 4, 5 weeks in a row with almost the exact same low, very close, somewhere between 30 and 31. And the lagging line held against the bottom of its cloud. We held right against the TDST line that goes all the way back to January of 2021. So all the support showed up exactly where it needed to. This kind of teal colored line goes back to the old highs in late 2019, early 2020, just before the market sold off sharply for COVID. So that had been the all-time high. So notice that we came back exactly to where all-time highs had been, bounced there and have moved up. So we certainly have a good bottom in financials. The question is, how far will it go? And again, is this a bounce that's the bottom and we go all the way back ultimately to retest highs? Or is this a bounce you still want to sell into, thinking that we're either going to retest the lows or possibly even take out that $30 or $30.50 level? So I've highlighted here some of the resistance going forward between 35 and about 36.5 or so, where I see the important resistance at this point. So to me, that's where I have to make that big decision of, do I sell out against also where prior lows were? These horizontal purple colored lines were old important lows. So there's a zone in here. We've got the weekly baseline right now from the cloud model. We've got the bottom of the cloud, depending upon how fast we get there. And we've got the bullish propulsion momentum level, which often ends up being a place of the market that's a bearish market can't really get above. So that's my zone where I make, have to make my big decision that I'm anticipating is coming in the next weeks and months. Let's look at this now versus the S&P. So let's get now relative sense of how financials are doing versus the S&P. And you can see I've drawn this bold horizontal green line, which not only caught the highs in 2020 in relative terms, XLF divided by spiders, but also all the lows since. And other than in the last couple of weeks where we've just tucked beneath, it's not enough of a breach for me to say that this area has really materially changed my view. Plus, I do think near term rates can go higher based upon last week's failed sell-off in the yield chart, or failed rally in the actual bond prices. Plus, we've already gotten to an 11 towards a 13 as a possible exhaustion signal to this down move here too. So I'm benchmark. I have benchmark exposure versus financials, and if they start, if they can build a base again above this green line, I'll probably go back to an overweight. But right now, I'm willing to be in financials. I don't want to be out of them, but it's too questionable which way this is going to go. So I have a benchmark weighting versus its actual weighting. I have the same weighting in financials exposure as they do in the actual S&P 500. All right, let's get to the stocks. Let's take a look first with Berkshire Hathaway. Notice if the low this year came 1 week after a setup 9 count right at the bottom of the cloud. We come bounced off the bottom multiple times, and now for the last 3 weeks or so are getting resistance against the top. So let me blow this up a bit. So you see there is some natural resistance here. If we get well above, then I'd look for a move that gets to 312 to 314 and a half or so. But for right now, this is stuck in between its cloud. And in theory, if it came down here to two kind of, where is that, 283-ish, perhaps you try a trading buy versus like a 274 Friday close beneath here, something like that. But right now, just the way this lines up, there isn't all that much to do. JP Morgan. Very different looking chart, far worse than what we just saw in Berkshire Hathaway. This has been trending downward since October when it put in its all-time high. It really hasn't been able to progress off of this area where the lows were made. So for right now, the only thing that's minimally positive is that it is above its conversion line, this pink colored line. If it gets a full rally, look for this to get somewhere around 130 against these highs from May. And that'll probably be where you need to make a decision again too, because that's also going to be where the lagging line bumps in the next month or so, would bump up against the bottom of its cloud. But not a terrific looking chart at all. Bank of America, BAC. Downside exhaustion signal on this year's lows. It's above its conversion line for a couple weeks now. Not a heck of a lot of upside momentum. If it rallies, look for resistance in the upper 30s. Support now from, I'd say trading support at about 32 and a quarter, 32 and a half. More important support down at 30.40. And new lows, if we get under 28.65, it's in trouble. It's going lower. But a definitively, well, not as bad as JP Morgan, but neither of these two bank names as good as Berkshire Hathaway. Wells Fargo. Slightly better than the other two names. Don't really have a defined bottom other than, again, the constant pounding it took in forming the bottom where we had somewhat equal lows, not as precise as JP Morgan had. Moving higher, resistance now about 48 and a half-ish or so up to, I'm sorry, 46 and a half up to about 48. And let's see if, so this made all-time highs back in 2018. You can, well, here, I'll just quickly do it. Let's see where this downtrend line comes in. It's not that different than the highs that we saw to start this year. So the thing here is where we are in current price. To me, I kind of look at it as the bigger downside takes us to 32.70. The bigger upside takes us to 56. That's 13 higher. That's 10, 11 lower. There's no vig in really playing it in the bigger picture. You're square in the middle, and your risk and your reward are fairly similar. SPGI, S&P Global. Bottomed on the 9 count, been trading higher. Look, resistance here at 386 and a half-ish or so, then above that 413. Not a bad chart, but, and this does actually look like, let's see, looks like I'm eyeballing this. Yeah, this downtrend line was broken. So at least you have that going for it. So, and if we take a look at where this bottomed in 2021, oops, hold on a sec. It is, in fact, roughly in the same place that old highs were in 2020 before COVID hit, the lows in 2021. So we've held where this needed to. You don't want to be long this name beneath 300 or so, but at 375, it's okay. None of these names are thrilling me. Morgan Stanley, my ex-home for many years, and where I was chief market strategist for a bunch of those years. Again, not necessarily a defined bottom per se. We've rallied here, look for resistance, close to 93 for the next month and a half or so. The bottom of the cloud is the same level, unrelatedly, to where this bullish propulsion momentum level is. So 93-ish, 92 and a half, 93, not a bad place to potentially take some off the table. Given that opportunity, I will make a mental note myself because I still have shares from all those years I worked there. This is Goldman. So Goldman, similar type bottoming, actually tucked for a week beneath its cloud, but that was it, a 1 week breach. It's come right back up. Resistance now 351, 352, and then kind of in the 370-ish neighborhood. This has not yet broken its downtrend line. So notice that that's in that same general zone. So something to pay attention to if you got some of those names on. Charles Schwab, SCHW. So we've got to clearly get above this level here in order to get some type of breakout and get the shorts squeezed on this in order to push it up to 76 and change. So down here, or up here rather, at 71 and a half, really it needs to get through. This downtrend line is also well above current price action. So it's not a factor at all here. So I pay a lot of attention to that, both the clouds baseline and that 76.40 level. If it breaks out, to see if you can get above that. If you're looking to be a seller, that's not a bad place to be a seller. Citibank. At least I kind of like better how this bottomed, including the week that made new lows and then closed above a whole bunch of prior weekly closes. So that's actually stronger. Now this still has some resistance where this line is, let's call it 53 and a half, 54, and then above that at 55 and change. You really got to see this get above there to then target something like almost $65. But I do at least like how this made new lows and then came all the way back and held against the TDSD line from October of 2020. And lastly, BlackRock. No defined bottom per se, but just multiple weeks of being able to generally hold on to this level. This still is somewhat in a trading range. I mean, it's just, it's trying to break out from there. Today's only Tuesday, so undefined whether or not this week really breaks this out or not. You've got the baseline here too. If it gets above, it stays above 738 or so is the next target. And then of course, the bottom of the cloud, top of the cloud going forward, pretty much it's the same place, somewhere around, I don't know, 815 or so, I'm guessing, 818-ish. This needs to hold above 606 in order for it not to sell off and make new lows. That's it for the week. Hope you enjoyed this show. Again, follow me on my new YouTube channel at In the Know Trader. Follow me on Twitter at In the Know Trader. I'm Rick Bensignor, and this has been In the Know Trader.